Okay, so let's say you suddenly get your hands on a big chunk of cash. Maybe it's an inheritance, a bonus from work, or you sold your company. First off, congrats. That's a great problem to have. But it's also a surprisingly stressful one. Because the next question is, what do you do with it? Right, you've got this cash sitting in your bank account and you know you should put it to work. Do you just jump in with both feet and invest it all in one shot? Or do you play it a little more cautiously and ease into the market bit by bit over time? That is the core dilemma we are going to unpack today. So on one side, you've got lump sum investing, or LS for short. That's pretty straightforward. You invest all the cash at once. On the other side, you have cost averaging, or CA. That's where you invest smaller chunks over a set period. You can think of it as one being a dive into the deep end, and the other is just dipping your toes in first.
Now, for most of us, our gut instinct, our intuition, it just screams that cost averaging is the smarter, safer move. I mean, it just feels right, doesn't it? It seems like the perfect way to protect yourself from that absolute nightmare scenario, putting all your money into the market on the single worst day possible, right before a huge crash. But is that feeling actually backed up by the data?
68%. I want you to just look at this number. It comes from decades of market data crunched by Vanguard, and it is pretty much the key to this whole debate. Keep it in the back of your mind. We're about to find out exactly what it means. So let's start with the cold, hard numbers and make the case for going all in. This is the argument for taking decisive action based not on what feels good, but on what has historically worked. The whole argument for lump sum investing really comes down to one big idea: opportunity cost. See, every single day your money is sitting on the sidelines in cash, it's like leaving your team's star player on the bench. Markets, over the long haul, tend to go up. So that uninvested cash isn't just sitting there, it's actively missing out on potential gains. Think about it like this. If you invest a lump sum, your money is in the game working for you for a full 12 months. But if you use a 3-month cost averaging plan, you're only fully invested for 9 of those months. You basically benched your money for a full quarter of the year, missing out on all that potential growth. And here's that number again. Historically, lump sum investing has beaten cost averaging about 68% of the time. So about 2/3 of the time, you're better off going all in. But wait, look at the bigger picture here. Both strategies beat just sitting in cash nearly 70% of the time. The data is telling us that the biggest risk isn't choosing the wrong strategy. It's the risk of doing nothing at all. And when you look at it in real dollars, the difference becomes pretty clear. After 1 year, a $100,000 lump sum investment, on average, turned into about $2,000 more than the cost averaging approach. That's the power of having your money in the market for more time. Okay, so the numbers seem to paint a really clear picture, right? Just invest it all, get it over with. But if it were that simple, we wouldn't be talking about this. It turns out we humans are not purely rational robots, especially when our money is on the line. And this brings us to the other, and I'd argue, equally important side of the argument. So now let's explore the case for just dipping a toe in slowly. This isn't an argument you'll find on a spreadsheet. It's an argument based on something way more powerful: our own human psychology. Things like risk, fear, and maybe most importantly, the fear of regret. I love this quote from a 2005 research paper. It basically says that some of these pre-scientific habits, these rules of thumb like cost averaging, actually have a kind of practical wisdom baked into them. They might not be mathematically perfect, but they've helped investors survive the chaos of markets for generations. And the core of that wisdom is understanding this concept right here: loss aversion. Behavioral economists have proven that for most of us, the pain of losing, say, $100, feels about twice as strong as the pleasure of gaining $100. It's a quirk in our wiring that makes us incredibly sensitive to the idea of a market drop right after we invest. And this is why that fear feels so real and so justified. I mean, look at this. Big drops during the year are totally normal. Look at 2020, a terrifying 34% plunge. But here's the crazy part. The market still finished the year up 16%. Our brains, though, they don't remember the final number. They fixate on the gut-wrenching drop. So maybe the best way to think about cost averaging isn't as a tool to maximize returns. It's a behavioral tool. It's a system that helps you manage your own emotions, to get past that fear of those drops and that potential for regret. It keeps you from making the costliest mistake of all, being so paralyzed by fear that you just stay in cash forever. All right, we've laid out the rational, data-driven case, and we've laid out the psychological, emotional case.
and they seem to point in completely opposite directions. So what's the verdict? Well, the truth is, there's no single right answer. It really all comes down to knowing your own investing personality.
Choosing the right path really depends on what you prioritize. If your number one goal is to maximize your expected returns and you have the stomach to handle the short-term bumps, then the data clearly points to lump sum investing. But if your priority is to minimize that feeling of regret, if you want a smoother journey and a system to help you overcome your fear of investing at the wrong time, then cost averaging is probably the better strategy for you. And this is probably the most important takeaway of all, and it comes straight from Vanguard. They say that just having a plan is the most important part. The biggest mistake isn't choosing the wrong strategy between these two. No, the biggest mistake is indecision. It's letting the cash pile up forever. So, at the end of the day, the numbers tell us what works on average. But successful investing isn't about being average. It's about building a strategy that you, with your own unique personality and emotions, can actually stick with through thick and thin. The data can tell you what works for a spreadsheet. But the real question, the one only you can answer, is this: what works for you?